So first of all, I'd like to introduce the session as such. Can we have the light reduced? You don't need to read this page. There's a few graphs, and I'll try to explain what is shown. I was told that there is an issue with the main light not being able to be reduced, but if someone could have a try, please. Now, this session is entitled A Prosperous Future Together, and we're particularly looking at financial and economic policies for inclusive and equitable development. So a slightly broader definition of development. We will no doubt mention some key shortcomings of the traditional approach to development and the sort of development policies that have been recommended and adopted in many countries in the post-war era. And we will mention alternatives based on the understanding of what has been the problem. Particularly the so-called Washington Consensus, the set of policies that have been actively advanced by Washington-based institutions such as the World Bank, the IMF, US Aid, the US Treasury, the Federal Reserve, have emphasized deregulation, liberalization, privatization, and the argument has been that that should lead to successful economic development, but for many countries it hasn't quite panned out that way. Particularly, many countries have suffered from, well, the opposite: lack of development, a high degree of inequality, the problem of substantial indebtedness, corporate but particularly sovereign national indebtedness of a nation to other external lenders, and that has created a whole set of other problems. For example, economists have been amazed that money seems to have been flowing from the poor countries to the rich, but theory says, the rich countries should be investing in the poor countries. But the facts are there has been a consistent outflow of total funds, if you net them out, from these countries. Why is that? What are the mechanisms? And so the aim of the plenary is to look at these, but also broader issues, and we have highly qualified speakers from many areas, including from economic and, from politics as well. And we'd like to consider this issue of development that includes equitable development, the quality of life, protection of the environment as development goals that clearly have been neglected in the past, and also a way for countries to develop so they can rise to the rank of equals in every sense, and there's national self-determination in line with the principles of democracy. Now, before coming to the distinguished speakers, I'd like to briefly set out some key points that I see as a trained economist in my past 25 years of researching this area. And I've entitled this The Washington Consensus versus Development Policies. Now, when I studied economics, I did it at the London School of Economics, and I majored in development economics. I was taught a particular set of content. Later, I taught development economics at universities in Japan and Germany, in the UK. And I noticed one thing: if you take a mainstream development economics textbook, in the beginning, it will say a little bit about the discipline of development economics. What is it about? And I was actually quite astonished to find the explanation, which is well accepted and shown in these textbooks, that development economics as a discipline is not very old. It's a fairly new discipline. Oh, really? We're told it was created in the 1950s and 1960s. Why is that? The textbooks tell us, well, the main reason, we're told, is that was the period of decolonialization. Many countries were for the first time set free from political control, set free from their colonial masters. Now think about this. That is an extraordinary admission. Why create the discipline of development economics at the precise moment when political control is lost over the colonies? Had the colonial masters been genuinely interested in developing their colonies, development economics would have been much older. Surely they would have created it 100, 200 years ago. And also by the time of decolonialization, countries would be well advanced on their way to full industrialized or advanced economy status. So should we trust the development economics advice delivered at that time by colonial powers that had not been interested in developing their colonies when these countries were under their total control? Now, let's just look at three key tenets of this development economics and advice that has been given to developing countries in the post-war era. Number one, developing countries need savings in order to grow. This is based on theories that started with Keynes and then the famous Herod-Doma model. You don't need to worry about the economics details, but that is the conclusion. You need savings to have investment to grow. Sounds very reasonable. But developing countries, it was found, have a low savings rate. What can they do? The advice was, we can give them savings. We can lend them money. And the international banks were right on the heels of the IMF and the World Bank, ready to lend. And this is what happened. And so a lot of borrowing was done by developing countries from international banks. Second key tenet is free market policies are necessary and sufficient to ensure stable and sustainable growth and development. So there shouldn't be government intervention, should be just the markets on their own. And likewise for international trade, free trade will deliver growth, development, prosperity, and economic independence is the suggestion. Let's look at these, and I want to start with the issue of savings, which has led to the indebtedness of developing countries. Now, the basic premise of this claim that you need savings in developing countries to grow and you can borrow them from abroad is that the money supply is somehow fixed, predetermined by prior savings. And behind this is an analysis that ignores banks. Banks are not in these models. Economic models have no banks in them. Now, most people with an understanding of just how businesses work, they will say, well, one of the most important things in the economy is, of course, banks. Economists don't seem to realize this. Banks are not explicitly modeled. So what are the implications? Well, the reality is very different from these theories on which the advice to borrow from abroad is based. The reality is banks are not just financial intermediaries. They're quite unique, quite special. They create our money supply. And so theories and models that don't reflect this reality, that banks are not just taking in savings and lending them out, but they do something else. They create the money supply. If you don't reflect that, that cannot then lead to the right policy conclusions. Very briefly, how do banks create money? Because banks do not lend money. No bank has ever lent money. When you take a loan, new money is created and added to the money supply. You sign the loan contract, the bank purchases the loan contract, puts it on the asset side of the balance sheet, and then it credits your account with the bank with the number, the amount of the loan. And it's called a deposit. You didn't deposit it. Well, the bank also did not deposit it, and it was not transferred away from anywhere else. It was newly created. And this is how the banking system creates the money supply, which of course makes banks very, very powerful. Banks create 97% of the money supply. This process is called credit creation. That is also at the same time money creation. Banks therefore decide who gets how much money and for what purpose is it used. And that decision reshapes the economic landscape within a very short time period. Now, the economics that is being taught in the post-war era does not show that. It's not in there. And certainly, particularly in the last 30 years, it has been entirely purged from the textbooks. That explains why, in reality, central banks look very closely at bank credit, and they often engage in guidance of bank credit. And so this understanding of how important banks are, that they create the money supply which you need for investment and for growth, is a game changer, because the right government policy influencing this process, the creation and allocation of money, will of course have a big impact, will allow governments to have growth without unemployment, avoid banking crises, have stability, avoid or reduce at least the business cycles, and of course help countries develop. So is it possible to achieve high, stable and sustainable economic development? Well, it is, and I'll just give you a few points on what needs to be done. But let's just already state that this claim that developing countries need savings in order to grow, and they can be supplied or should be supplied by the international banks, the foreign lenders, is deeply flawed. There's no evidence to support this. The fact of international banking is that foreign money lent by international banks can only be used to purchase foreign goods and services. It cannot be used and is not used in the domestic economy at all. It doesn't even reach the domestic economy. Now, we also know that a number of countries succeeded without foreign borrowing. Germany, Japan had their significant economic rise without any significant external borrowing. So that means the international borrowing clearly is not needed, and also a country that has a low savings rate doesn't need to first accumulate savings. If it has a banking system and a central bank, it can create growth. So growth is possible without borrowing from abroad. Now, if you're interested in this, I just want to make the point that, so what happens when a country borrows from abroad? Let's say, well, South Africa, as a country, they are borrowing, and they're borrowing from abroad. So let's say they borrow from the international bankers. And they borrow inevitably in foreign currency, because the international banks want to lend in foreign currency, which of course means the currency risk is taken entirely by the developing countries, not by the experts in hedging and handling risk. So South Africa borrows from UBS in London pounds. This loan contract creates an asset, which means the UBS London will actually create these pounds newly. They will be newly invented. And there will be a deposit shown, a credit shown for South Africa. Now, that's pounds. Let's say they believe these development advice recommendations, they want to use this for domestic growth. They clearly need to switch them into South African rand. What happens then? Well, actually, quite ironically, when they sell their pound deposit and purchase South African rand, a South African bank must be involved. And the South African bank will, at least initially, give a loan to UBS in London, which then will be an asset to the South African bank. So, you see, it's the developing country lending to the advanced country so that they can lend back. And then the South African bank will create the South African rand deposit out of nothing, the way banks always create money out of nothing. And the pounds, of course, don't enter the economy. They cannot in the system that we have. And so you realize this entire borrowing from abroad is effectively, well, you could call it just a con. It's not needed. The foreign bankers just create the money out of nothing, which is what the developing countries could do themselves to create the investment and the domestic growth. So this claim is clearly wrong. In fact, there are no international capital flows, strictly speaking. Money doesn't flow in our modern banking-based system. And money is created by banks, which developing countries can and should use for their own development and for their purposes, whereas the foreign lending makes them dependent in foreign currency. It's been shown most commodities exporters, many developing countries, their currency over time weaken. Therefore, their foreign debt in domestic currency terms goes up. And that explains, and then you service this with interest, compounding interest, that explains why more money is flowing from poor countries to rich due to this lending trick. So developing countries can use the power of productive credit creation by making sure banks lend domestically, create money, and use this productively to build up their economy. So why is the wrong advice given to developing countries for the last 50, 60 years? Advice that clearly serves the interest of international banks and their friends at central banks, and advice that has destabilized many economies and led to many problems. So it's time to use the power of the monetary system for the benefit of the people. We won't have time to go into this, but as long as you ensure that bank credit is used for what's in this chart, the green area, transactions that contribute to creating goods and services, productive investment credit, you will get high growth. This is precisely what the successful East Asian economies, Japan, Korea, Taiwan, and also China, did. They guided credit for into the productive areas and avoided credit for financial speculation, which doesn't contribute to GDP but creates asset boom-bust cycles, and banking crises. So in Japan, when bank credit expanded a lot, much faster than GDP, that created the bubble. But the same in Europe. The ECB allowed credit growth in Spain, in Ireland, Portugal, and Greece to rise by 30, 40%. This had to create the problems that we've experiencing since. And so this means we have to also talk about the power of central banks, because they're the ones that have been monitoring very closely what banks have been doing. They have all the tools needed to ensure that the right amount of credit is created and used for productive, good, sustainable activity without micromanagement. We're not talking about a planned economy at all, because you can just characterize different types of credit. And you leave the decisions, of course, to the banks, which particular company gets the money. But when that has been done well, it leads to sustainable growth without crisis. We've seen central banks abusing this power, though, such as in the Asian crisis in the 90s, when it was central banks and international organizations that effectively adopted this string of strange policies that had to lead to the Asian crisis. The same set of policies that was earlier implemented, imposed on on Germany in the 20s and 30s, and then also on Japan in the 80s and 90s. And again, it's a mechanism used by the ECB to create this instability that we've been witnessing. And in case you think, well, that's nice with hindsight to criticize the ECB, I'd actually warned in 2003 in my book, Princes of the Yen, that this central bank is too powerful and not accountable, is modeled on the German Reichsbank, a very bad central bank, not on the quite successful Bundesbank. And the difference is its complete lack of accountability, and that power tends to get abused, and this is exactly what we saw. So I warned of the boom-bust cycles that the ECB was likely to engineer and recessions in the Eurozone. Now let me wind up, because I'll just quickly mention only the other two claims, focused on one due to time limitations. The evidence that free market policies are necessary and sufficient to ensure stable and sustainable economic development, of course contradicted by the empirical facts, and you can check for yourselves whether we talk about Manchuria in the 1930s, Japan from the 30s to the 80s, Taiwan, Korea, China, or indeed England from the 15th century onwards, where we had clear industrial policy protection, infant industry protection, or the US in the 19th century, or Germany in the 19th-20th century. These powers became successful due to clever intervention. There is no country that has become a major economy based on just free market policies. What we've seen is the success of the guided economy with targeted government intervention in the form of conscious institutional design and guidance of bank credit. So this claim is not true. What about the other claim that free trade will deliver growth, development, prosperity, and economic independence? Well, I think Africa and Latin America has given us many counterexamples to contradict that. We've seen underdevelopment, inequality rising, and economic and political dependency. You could even argue that the Washington Consensus has not enhanced but prevented development and replaced the colonial system with its economic equivalent, which would explain why suddenly, when countries were decolonialized, it was decided, oh, we need development economics, and here it is, and this is what it does. But there's an alternative approach to development, and that one, as we've seen in the successful East Asian economies, is based on domestic policies to enhance the economy, using the power of the banking system to create credit productively. And this can be used to enhance the quality of life and protect the environment. So we need to introduce sustainable development by having more equitable policies, not policies that create dependence, economic dependence, and an international debt problem. And as you know, the debt has been used to swap for equity. Ultimately, domestic resources get controlled by the foreign lenders. But all that can be avoided, or even now step by step reversed with the right policies. And I think one other important aspect is, my final point, people need to be empowered, and this has to go down to the local level. Communities have to be empowered, and this can be done with the banking system. We can return the power to create money to the people to whom it belongs by introducing a network of independent, not-for-profit community banks. Now, some of you may think, well, that's a nice story. Is this ever going to happen? Well, this is what has happened in Germany for the last 200 years. It is at the core of the German economic success in the last 200 years. 70% of banking in Germany is not-for-profit local community banks that have been lending to small firms that have therefore become major exporters, small family-owned firms. It's the backbone. The small and medium-sized enterprises, the Mittelstand, is the backbone of German economic growth and stability. And that can be done also in other countries. We are doing this in the UK. We're setting up community banks in the UK. The UK, due to the power of the City of London, has resisted this for the last 200 years. We have 5 banks controlling the entire banking market, only lending to big firms and largely hedge funds and private equity funds for financial speculation. You know the outcome of this. But we're introducing local banks, starting with Hampshire, the Hampshire Community Bank, to be launched in a year's time. And we also like to expand this to the whole of the UK, in fact, also other countries that should consider this model. Now, this is where I end my talk.